welcome to the Global Chief Investment Officer Symposium, Paradigm Shift, Global Investment in a Restructuring World, co-hosted by VS Partners and Financial Times and FT Chinese. Founded by established portfolio manager and renowned entrepreneurs, VS Partners pioneers a boutique outsourced chief investment officer model in China to invest globally. I'm Ryan McMorrow, moderator of today's panel, What has the World Gotten Wrong About China Investments? And joining me today are Bin Li and Samo. Dr. Bin is joining us from Shanghai. He's the founder and CIO and CEO of Lake Blue Capital, the largest China-dedicated healthcare manager with over $3 billion in assets under management. He's been ranked #1 Asia healthcare analyst by Institutional Investor for 7 years, and the #1 China healthcare analyst since 2010. He was also rated the best Asia healthcare analyst by Greenwich, Asia Money, and the Wall Street Journal. Welcome, Dr. Bin.
Thank you. Thank you, Ryan.
Sam is joining us from Burlingame, California, in the heart of Silicon Valley. He's the managing partner and CIO of 101 Capital. Prior to founding 101, Sam was a TMT portfolio manager and member of the investment committee at Passport Capital. He was there from 2009 to 2017 and managed to carve out with full discretion from 2013 to 2017. Prior to that, he was at AT&T Labs. Thanks for joining us today, Sam.
Thank you for having me, Ryan.
Great. Let's get started with the panel then. Both of you are somewhat focused on China. Can you name a few common misconceptions that global investors and the general public may entertain about Chinese tech, TMT, and healthcare opportunities at the moment? And so what is leading the global community to these misconceptions, and what are the harms of these misconceptions? Let's start with Dr. Bin.
Thanks, Ryan.
Healthcare.
Yeah, sure. So I think one of the misconceptions about China healthcare, which is the sector that we are focusing on, is there's very little innovation in China. And I think the reason for that misconception is, yes, historically, it's true. If you look at 10 years ago or 10, 15 years ago, China, most of Chinese companies are making generics. And recently they're transforming from generics to make Me Too. But I would say today it is, this misconception is kind of proved that China healthcare, by the China health industry, that China healthcare is really transforming from generic industry to very much of, or at least inspired to becoming innovative industry. They are making a lot of innovative, or trying to make innovative drugs. And in fact, we are seeing some multinationals are licensing drugs from Chinese biotech companies. And this kind of collaboration is a validation of the technologies that came from Chinese companies. And so I would say this kind of R&D transformation has been ongoing, as I mentioned, for the last 10, 15 years. And that obviously evolved well for the industry going forward.
Got it. That makes sense. Sam, what about on the tech front? What are some things we in the global community might be misunderstanding and misviewing on China at the moment? I mean, there's been a lot of change in the last year. Tell us about it.
Sure, right. I will name two. The first one is more, I think, more broader. Is I think what we get a fair amount of feedback from investors is China is a black box. So to us, it's actually a misconception, because if we look back in history and check the sort of significant events that happened, and for the tech and media telecom space, recently the sort of regulatory tsunami that started from really sort of the beginning of this year. So the political bureau statements actually told us back in December of last year. And if we look at what's happening, so the crackdown on the real estate market and the property market, actually they told us in August of last year. So it's actually China actually in general, they tell us the direction where they're going. They really the onus is on us investors to figure out to what extent they want to do. I think the other misconception is specifically to some TMT is a lot of investors largely equating some China TMT to consumer internet companies. Yes, the consumer internet has grown massively over the last 20 years and driven significant returns for global investors. But there are actually lots of other tech companies, like in semiconductors, in industrial technologies, and even like renewable energies. And I think the factors contributing to some of these misconceptions are, one is many are not used to really analyzing the macro picture in China. And also just in terms of equating China TMT to China internet companies, I think partially many of the hard tech companies, they require some domain knowledge, which is not easy to develop. And also most of these hard tech companies, they are listed in the A share market, which are less familiar to global investors.
Yeah, that makes sense.
And Ryan, maybe if I could echo what Sam is saying, when it comes to policies in healthcare sector, I think there's also misconception, from investors or from many others that healthcare policies are somewhat unpredictable. Again, I think it's not true. For example, price cut, which has been the focal point for market or headwinds for investors, it's becoming more routine. The price cut has shown patterns in terms of the scope of products, the magnitude and time of the price cut. They're becoming more routine and more predictable. So that's a misconception. And what has led to that misconception was, yes, 3 years ago when it first started, no one knew when it's going to happen, how it's going to happen. But then after a few rounds of price cut, and it become very predictable now.
Got it. Yeah, I mean, I guess people might look at like a Western democracy, for example, the US, and any legislation that's going to get passed goes through, probably takes a year or two. But in China, some things can kind of pop up on us if we're not paying attention. I guess the key with both of you guys have probably found is paying attention to what the policymakers are saying. Both sectors in China that both of you are investing in, healthcare and tech, have been hit hard by the policy headwinds and changes this year. What are the resilient entrepreneurs that you both talk to? How are they coping with these changes? Could you name an example or two of companies or entrepreneurs in each of your sectors that have managed to continue to grow with all the changes that are coming down?
Sam, please. This time first.
Sure, Ben. In tech, we are seeing two trends, I think, from resilient and forward-looking entrepreneurs. So one trend is some of the more forward-looking entrepreneurs. They are really strengthening their competitiveness by one, improving employee welfare, such as raising wages and limiting overtime, things of that nature. and by self-regulating better. So longer term, actually, those position them much better, especially compared to the weaker competitors. The other trend we see is some of the stronger companies that are also actually pivoting into areas which are supported by policy. For example, semiconductors. And yeah, it's I would say it's a long-term sort of play, but I think the direction is actually makes a lot of sense. I think the other trend that we're seeing is this is not limited to tech. Some of the consumer companies are doing this as well. So we're seeing some companies are trying to take advantage of the pullback in the market to consolidate the market. For example, some of the leading property management services companies actually have been making highly accretive acquisitions to consolidate the highly fragmented market. And we expect these types of moves to really pay off longer term.
Dr. Bin, what about you? What are you seeing in terms of resilience in how entrepreneurs are coping with the current environment?
Yeah, sure. I think the companies or entrepreneurs in my sector, their way of dealing with this kind of pressure is going more innovative and going global. And they understand that as the domestic market is becoming more competitive, because everyone in my sector is trying to be innovative. So just being mediocre innovation or innovative is not enough. You really need to set the innovation standard very high, i.e. the global standard. So whenever you, for example, you try to file clinical trial or clinical study for your drug, you want to do it both in China and outside of China, in US, in Australia, in UK, so that when your drug is entering clinical trial, you really set the global standard for the future approval, not just by Chinese FDA, but also by regulators outside of China, especially in the US or other global markets. And also for some of the companies that are not making biotech or pharmaceutical drugs, i.e. if they're selling medical device product, they are also trying to tap into the global market by doing lots of exports. So a case in point would be a company called Mindray. And so this is a company that has been very, very consistently trying to come up with proprietary products. Originally it came from an OEM background, but then they made a few acquisitions in the US and outside of China, and they start to penetrate into the major markets. So when you look at this company's product or business, they're coming from both export business as well as a domestic business. They are becoming a very dominant medical device supplier in China, and an important medical supply globally. And this is also by doing what I said, being innovative and going global.
For the healthcare clinical trials, it seems like one of the, or at least what I hear, one of the big advantages is there's so many potential patients to put into the clinical pipeline in China. Does that help Chinese companies test their drugs quicker?
You're absolutely right. And there's a little bit of nuances in there. That is, before China joined what I call ICH, it's an organization called ICH, which is a global clinical trial standard. Before they recognized that, whatever you did in China the data cannot be recognized by US FDA or European regulators. But China joined that organization called ICH. It actually recognized the ICH standard. So it's like China joined WHO, WTO many decades ago. That it effectively really raised the clinical trial standard for Chinese companies and also the clinical sites in China, so that it can be integrated into the global trial. And by that, like you said, the advantage of having large patient population really, is showing or leveraged by not just Chinese companies, but by multinationals such as Pfizer and Merck. They're doing China trials.
Yeah, that makes sense. Was joining the ICH recently, or was that
it's 2016, 2015, that time frame. So it's been a while. So as I said, we're seeing increasingly global trials conducted by multinationals as well as by Chinese domestic companies. So global trial meaning they can, in a trial, they can admit US patients from sites in the US and also admit Chinese patients from China sites.
That makes sense. So with the capital markets overly bearish on China right now and China tech and maybe healthcare here as well, is there must be a valuation gap in some opportunities in the market. Are you all seeing that? Are there great value opportunities right now with the sentiment being perhaps different from reality? Sam, what do you think about that?
Sure, Ryan. Yeah, so the tech and part of the consumer space have pulled back a substantial amount. If you look at this, so the China Internet ETF, KWEB, I think it's down somewhere close to 40% year to date, and more than half from its highs in mid-February. And so valuation for the space has really rationalized and derated, and for some actually have become very attractive. To be clear, the regulatory impact in most cases is going to have some fundamental impact, which will affect earnings to some extent. But at the same time, given the huge pullback in share prices, our view is for some of the companies, the pullback actually more than compensated for the fundamental impact. And if we really look at it longer term and think about the implications, really some of the weaker companies will probably be weeded out because of more stringent regulation. So the stronger ones can actually potentially can have more opportunities. Although at the same time, we're also cognizant that because of the fear about regulatory developments, so the valuation multiples may not really sort of go back to where they used to be. So for us, we're looking at really the strong companies that can still compound earnings at a very attractive rate, let's say 20% plus. And then potentially for some, a selected few can still repair a little bit. Potentially we can get a 30%-ish IRR. And then, so we're looking at those companies, and we've been gradually adding to those names.
Dr. Bin, has the healthcare pullback been as stark as in the tech markets? And do you also see opportunities there?
You know what? I think it also pulled back anywhere between 30 to 50%, depending on which stock, which subsegment. So it's, I guess it's very, close to what Sam said. However, the pullback mainly happened in the summertime, since the summer. But when you look at the impact for these programs, what is impact from? People are saying, well, it's probably caused by the policies in healthcare. But when you look closely, no new major policies really announced since summer. I mean, there's no surprise. Most of the policies were actually announced prior to the current correction. They like I said, they were set up maybe a few years ago. I think the sector correction is more correlated to the general market correction, or suffer some collateral damages. And indeed, last year the sector had a very good rally, perhaps along with the tech sector. And for some of the stocks, the valuation at time was probably too high. Now I think we're entering oversold mode for the sector. If you look at the fundamentals, many companies just reported good, very strong third quarter earnings, and most companies were tracking delivering anywhere between 20, 30, 40, or even 50, 60% of earnings growth, year-on-year earnings growth. And for companies like biotech companies that do not have earnings, right, they are showing very solid progress on the pipeline development. So I think fundamentally, these companies are actually becoming strong and strong, and yet the valuation has suffered a lot, especially for the no earnings and no revenue companies. Many of them were just listed through IPO route, and in our view, they're becoming more attractive. And again, if we take a step back and look at the healthcare industry, again, I want to draw an analogy between healthcare and tech. These companies, fundamentally, they're very strong. The industry itself, if you look at the underlying growth of the industry itself, it is a few times of GDP. China GDP is growing at about, they call it 5-6%. The industry is growing at least 2 to 3 times of GDP, and has been like that for the last decade, 2 decades, and it will continue to be like that for the next decade. And also, healthcare industry in China is growing at 2 to 3 times of US healthcare. And the valuation, if you look at the PE on gross PEG basis, they're still very attractive. And even if you look at PE basis, they're approaching a historical low or below the historical average. So we think this kind of correction creates some buying opportunity for some of the stocks that that we've tracked for a long time. And of course, there will be more volatility going forward. So this is really the buying opportunity, I would say, for long-term investors.
Okay. So would you be able to share what % of your portfolio is invested in Chinese companies versus global companies, or American biotech company, or are you entirely China healthcare focused?
We're mainly China healthcare focused. Yeah.
Okay. So the China healthcare market. I've been watching the U.S. biotech market, which I've seen pull back. But it sounds like China has followed the U.S. outwards.
Yeah, and there's a correlation too.
Okay.
Correlation too.
Yeah, that makes sense. So both tech and healthcare, these are both like complex global supply chains. We've seen supply chain disruptions because of COVID in semiconductors and in vaccine shortages. And this is kind of showing everyone that we need to be collaborating, which is definitely hard, but seems to be the only way to solve these issues. Do you see these disruptions impacting the companies that both of you are investing in? And if so, how do you redesign your investment strategy? Dr. Bin, why don't you start?
Yeah, so I think, what the good news is when it comes to healthcare industry, I think both governments understand the importance of a global collaboration, as you said, especially in solving medical problems, right? And for example, facing global diseases such as COVID. And many people probably forget that it was Chinese scientists that first published the sequence of the virus, and then quickly scientists in Boston, and also Germany and other countries, quickly they developed mRNA and vaccines based on that sequence, right? And this was the global collaboration in science to face the pandemics, and that's a very, very good example. And also people remember, when pandemic first broke out in Wuhan, the whole world, provided much needed medical devices and supplied to China. And later on, reciprocally, when it spread to outside of China, China became a major supply of medical devices to many other countries, right? Now, having said that, like you said, there are certain areas also in healthcare that both governments are very cautious. So for us, either as an investor or as many healthcare companies, they're very, very cautious on that part of business, right? And we were very cautious when making investment in companies that are handling genetic data. So when we look at when we try to make investment in Chinese companies, we spent a lot of time trying to do what we call legal DD or legal due diligence to make sure these companies follow the rule and do not have any patent or IP issues. And that's the adjustment we have made. I think in the past few years.
Got it. So for your private market investments, do you have a dollar fund or a renminbi fund?
We have both. Yeah. So we can invest both so-called offshore companies, offshore registered companies, or onshore registered companies.
So for the you mentioned the genetic material being sensitive for companies that are working on that. Does that kind of route them down the onshore route and an onshore IP?
Yes, you're exactly right. So these companies have to be onshore, right? And these companies, they cannot, for example, list it, in outside of China, right? And the business is strictly onshore. So for us, for investors who want to make investment, they have to be domestic investors, right? So,
do you plan your funds for a longer time period, or how do you deal with that?
Yeah, I mean, so typically, and that's just, I'm not speaking for our fund, but for RMB investment or RMB investors or people investing in domestic companies, domestic listed companies, usually the funds have a longer exit or longer fund life to cope with the longer exit time.
And no, I was just finished to say Chinese securities regulators are overly, and for a good thing, focused on retail investors, whereas in the US there's not that same focus. But Sam, what about you with the decoupling going on? Is that impacting the companies that you're investing in, and how is it affecting your investment strategy?
Sure. Yeah, Ryan. Yeah, I'm with you. I'm rooting for global collaboration. But as investors, our observation has been that there's been a broad technology sovereignty really happening since, I would say, 2019-ish timeframe. So what we've seen is major countries trying to be more self-sufficient in strategically important technologies. And we see this in the US, in China, and in Europe, and rest of Asia as well. And so that's one trend we've been seeing. I think another I would say disruption is to the just-in-time supply chain model that was perfected over the last 30 years. your just in time is highly efficient, but at the same time is somewhat fragile, or at least not very resilient. And so that's why we're seeing a lot of supply chain disruptions over the last, really ever since the pandemic. And so what we are seeing now is many companies under our coverage, they're trying to build more inventory and to be less reliant on the just-in-time model. So just for our investment strategy, what we have been trying to adjust to is we're trying to identify companies that benefit from technology sovereignty. For example, companies that facilitate capacity expansion of strategically important technologies, and typically companies in some of the semiconductor area or related areas, and also companies that benefit from domestic substitution to improve self-sufficiency ratio.
Okay, that makes sense. When do you think these semiconductor supply chain issues are going to resolve themselves? Are we close to an end, or is it still far off?
Yeah, it's a like $1 trillion question there. So if you ask different every semi investor will have a different view. Our view is that the part of the semi supply chain will continue to be very tight, but some part of the subsectors are loosening up. We're seeing that memory side loosening up and display loosening up. But for some of the more auto-related areas, semis, and some other areas, still very tight. And when we look at longer term, because there's more data, we're just accumulating so much more data, and as things go into the cloud, we need much more processing power. So that's in the cloud, but at the same time, on the edge, we have way more IoT devices, Internet of Things devices, and now also the world, at least most of the developed world and China are pushing 5G as well, and with the auto electronics semis. So this demand continues to grow, and so that's a longer term secular trend in our view. And then the adjustment to the just-in-time supply chain model, so that's more of a step function. And our view is parts of the supply chain will continue to be very tight, but for some parts will probably loosen up very soon.
Chinese internet has developed in a very different way than the global internet. Many of the big companies have their own closed-off ecosystems. So what do you think is the policymakers' aims here, and how do you plan your portfolio around what the policymakers are aiming for? Sam, do you want to start?
Sure. We think there are two important objectives of this policy moves. One is more domestically just sustainable, inclusive growth, and then two is sort of externally national security. If we look at China's development model, under the classic solo growth model, China has done a remarkable job, over the last 40 years in driving growth from all three factors, capital, labor, and productivity. But going forward, I think in some of your articles you've also discussed really, the capital lever is becoming much more difficult because of the much higher debt levels. And then the labor lever is even more challenging because of the aging population and also the more concerning declining birth rate. So that really leaves technology progress as sort of the key driver. And the significant pressure from the US, especially from the Trump administration, that really likely accelerated and in some cases probably necessitated some of China's plan for technological progress. And so in our view, this pivot is many years in the making. It's not like an impulse decision. But the policy, reprioritization, largely passed in 2020 because of COVID, and resumed in late last year. So the way we're looking at this is sectors that are aligned with policy priorities, such as some of the foundational technologies, semiconductors, industrial technologies, software, and renewable energies. So those will have great tailwinds for many years to come. But at the same time, the sectors on the I would not say the losing side of policy, but more or less favored side of policy, such as consumer internet companies, especially with large amounts of either user data or private education or real estate. So those could face, I would say, very continuous headwinds, to sort of varying degrees. And in terms of just the portfolio risk management, we think just position sizing is becoming more important because you don't want one of your sort of biggest positions get hit by some unpredictable regulatory development.
Yeah, that makes sense. Thanks, Sam. Dr. Bin, what about you? What regulatory moves have been impacting healthcare, and how do you position for it, and what do you see their objectives? You mentioned the price controls. Have there been anything else?
Like I said, the healthcare industry did suffer some corrections in the summer, but when you look around, there were no new major policies. All the policies that people have concern about, they were there prior to the summer, and it's been around for a while. So I think one of the reasons that people attribute that to the policy is because it's a renewed or awareness of potential healthcare policies that when people see policy hit on other sectors such as education, people worry about the spillover effect to healthcare. Yeah. Right. And but we're not seeing that. I think the government has been pretty clear about fundamentally they want to support healthcare industry. They want to increase the affordability as well as the accessibility for the population. Of course, they want to contain the medical cost, but that kind of medical cost containment by price on generic drugs, they've been there for a while. Like I said, it's been a routine policy for the government. In terms of how companies are coping with that, the companies are just trying to be, shifting from making generic drugs to more innovative drugs. In terms of, how investors such as us want to cope with that, we are, more focusing, or allocating more of our portfolio to healthcare, to innovative names, to the company have less exposure to price cuts, or to some of the sectors that have nothing to do with so-called reimbursement list, i.e. the product are not reimbursed by the government. For example, the sort of consumer healthcare names or out-of-pocket spending products, and that will help us to hedge the short-term concern on the price cuts. Again, I think the valuation for many of the companies have come down to a very attractive level, and we've been buyers for some of them. Yeah.
Okay, great. Well, that's all my questions for both of you today. Thank you for taking the time. It sounds like you both are pretty optimistic. So let's hope the market sentiment catches up with your forward thinking soon. Thank you, Sam from Silicon Valley, and Dr. Bin in Shanghai. It's been a pleasure hearing your guys' thoughts on where China is going.
Thank you, Ryan.
Thanks, Ryan. Thanks for having me.
Okay. Bye.
Bye-bye.